Désirez-vous que j'effectue la lecture des consignes en anglais ou en français?
Anglais, s'il vous plaît.
Each team has 20 minutes to present its case to the judge. I will show you a board of the 10, 5, last 2 minutes, and the 30 last seconds of the presentation. During the last 10 seconds of the speech, I will indicate by means of my 2 hands the number of remaining seconds. A team not having headed this presentation after 20 minutes will be stopped to move on to the period of question. A period of question of a maximal duration of 5 minutes is assigned to the jury at the end of the presentation. I would like to remind the jury that it is mandatory to ask at least one question during this period. I will invite the judges to introduce themselves and then the team can begin.
So, hi everyone, my name is Pierre. I'm the tax manager here for Boudreau Albert Savoy in town, a local firm. I was in your shoes not that long ago, so I know what you guys are going through. But it's a good competition and a good time, so hopefully you guys are going to have fun with this.
Hi, I'm Pauline Beautour. I'm the senior manager at Ernst & Young here in India. Good luck.
Good morning, everyone. My name is Sabrina Lapierre. I've recently moved back to New Brunswick and started the position with Ernst & Young in Dieppe as a senior tax analyst. Before that, I've done almost 2 years of tax practice in Calgary, Alberta. Like Pierre said, I was there before, not too long ago, if I can say. So that being said, I wish you good luck, and look forward to seeing your presentation today. Thank you.
Yeah. All right, so as you probably all know, there's 2 things that we can't really avoid in life. The first one is death, and the second one is obviously taxes. So the classic joke. Good morning, Paula. So you own Aqua Inc. We are DPS Taxation Services. My name is Matteo Pisano, and these are my 2 lovely colleagues, Naresh Duna and Florence Saint-Arnaud. And we'll obviously be today advising you on certain things that you've brought forward to us. So, before we start, let's get into some key considerations, just to reiterate to you exactly what you've asked us to do. First of all, you've asked us to calculate or advise you on the taxable income as well as the taxes payable for your corporation, Aqua Inc., which has a year ending of July 31st, 2016, which has passed, as today we are, or you'll put yourself on October 22nd, 2016. In addition, you've told us that there has been an offer by one of your competitors named Fishnet to buy or perhaps purchase certain assets or shares of your corporation. We'll also be advising you on these issues. And finally, you've also asked us to give you some tax planning advice to ensure the feasibility for both you, your husband, and your children. So essentially, this will be our agenda and mandate today, is to really advise you on these issues as well as provide you some tax planning advice. So just to reiterate or to present to you the organizational structure and where is your corporation today, so we can give you some context as to exactly what we'll be suggesting to you later. Here you are, Paula. You have 100 Class A shares and 1,000 Class B preferred shares in Aqua Inc. In addition to that, there is this family trust which has 100 common shares of interest in that same corporation. In addition, you've also told us that you do own certain shares in a holdco, and that holdco, is named Tools Plus Inc. So this is just to give you some context. So before we start getting into really the tax planning advice, we wanted to give you a sense of what your taxable income was as at July 31st, 2016. We know that to calculate taxable income, you have to reconcile between GAAP net income and Division B income. So we're going to propose some adjustments here between those 2 types of income. First of all, the bad debt expense. We know that on the income statement there has been a bad debt expense that was claimed. For tax purposes, a bad debt expense cannot be claimed. However, subsequently, a reserve for bad debts can be claimed per ITA 21. So there's actually, we're going to get to it later, but there's actually a nil effect. For the advertising and marketing, the account, although named advertising and marketing, did have or was fully comprised of donations. As we know, donations for Division B purposes of corporate tax are not deductible, so we're going to have to make an adjustment and add those $15,000 donations back. So what is our key tax away here today? Well, for the bad debt expense, there's nil effect because we're adding and subtracting that reserve. For the donations, we're going to add $15,000 expense. For the maintenance and repairs for the building and vehicle, we saw that they were expensed. We just wanted to bring it to your attention that there might be possible capitalization purposes here. If that is used for, or to help generate operating income or to bring future value to the corporation, you might have to add those back and capitalize that as a capital asset instead, just for your common knowledge. Meals and entertainment here. We know that meals and entertainment are only 50% deductible to corporations. It seems as though you've deducted 100%, so there's going to have to be a 50% adjustment. However, the travel costs, because they are fully related to work, can be fully deducted. That's fine. So what is our key tax away? The main one I'd like to bring to your attention is just to add back 50% of those meals in the amount of $43,500. As for depreciation, probably you know the most common adjustment in the reconciliation. It's going to have to be added back because we can deduct a capital cost allowance, which is depreciation for tax purposes, and that's going to be in the amount of $178,800. The amount that you're going to have to add back of depreciation will be the full 100% amount of $166,000. Now you're probably asking yourselves, how did you get to that $178,800? So here we are. Here's a beautiful capital cost allowance schedule. So what it is, we know that the building is 100% used for manufacturing purposes, so it is eligible for the 10% rate. The equipment was a bit tricky. There's not much information about what this equipment is used for. Is it simple office equipment? Is it manufacturing and processing equipment? We took it as a 20% rate of Class 8. However, had it been either for manufacturing and processing equipment, it could be either Class 29, 43, or the lovely one introduced this year, which probably got us all excited, Class 53. So we have to be able to assess that with further information. And for the vehicles, they're capped at 30%, whether in Class 10 or 10.1. So that was just to provide you the total justification for that. So what is Division B income? We started with $376 pre-tax income, so we added back implicitly the accounting tax because we'll calculate it now, and we made all these adjustments to come out to around $421,700 of Division B income. Now, before we get to the total taxable income and the Division C deductions, we just wanted to advise you on certain things here that we thought were notable. The first thing is the employee benefits. So, although the employee benefits, if reasonable, can be deducted as an expense, the issue is we have to assess what are these benefits and what are their nature. For instance, if there was an unreasonable car allowance in there, that would not necessarily be regarded as an expense to the corporation because it's unreasonable. So we're just going to have to advise you for further information regarding these. For the insurance, perfect, it's required by the bank, it's collateral for a loan, it can be deducted. However, once that loan matures, that won't be necessarily required for collateral anymore. As a result of that, you'll have to adjust back. And finally, for the interest and bank charges, this is not a thin capitalization situation, which is when the equity balance is 1.5 times the debt balance. So they can be deducted. However, just to advise you that in the event that it does get to that, the interest and bank charges might be a bit iffy to deduct. So what are the Division C deductions that get us to taxable income? It's actually only Division C deductions. Donations. Typically, there's dividends that can be deducted, as well as carryover losses. However, we didn't have any in this situation, so we're in the clear with this one. And our final taxable income comes to $406,700. What is the tax on this? Well, we have the 38% general base rate. We have the 10% abatement, as you probably know. And then we have the small business deduction of 17.5%. So we came out to around 10.5% tax rate, which gives us $42,704 taxes. There are no Part 4 portfolio dividends, as we did not receive any this year. Now, before we continue, we just wanted to assess on whether this was a QSBC or not, because it's going to be useful in the future when we start making our conclusions and recommendations to you. So we just wanted to get it to get in your head right now. First of all, what is a QSBC and what are the criteria? The first is that it has to be Canadian-controlled private corporation. 50% of the fair market value of its assets need to be used in an active business in Canada. The shares have to be owned for 24 consecutive months. The corporation has to have less than $50 million of assets. And the biggest headache, I guess, usually, is the 90% plus active assets on the date of sale. There hasn't been any sale of shares yet. However, we've temporarily calculated it as at today. We have total assets of $5,274,000, and we have active assets here of $5.066 million. So we've actually reached a threshold of 96.07%. We meet the 90% criteria. We are a QSBC. Hooray, we're all happy. So, now to get into the second major point, which is offered by Fishnet. We're going to separate this part into two sections, the sale of the assets or the sale of the shares. So, let me start with the sale of the shares and just bring you to some general various advantages with regards to this. First, as we know, it's very simple. It's just a sale of the shares, one-time transaction. It can be either a redemption or a sale to a third party. It's one time. It's eligible for the lifetime capital gains deduction because you are selling shares of a QSBC in this case, as opposed to selling assets which are not part of that criteria. Gains are only 50% taxable, as opposed to if you sell assets and you have a recapture, you're going to have to include it 100% into your income. And if you sell the shares, you won't need to operate this business anymore, which we know you, Paula, have told us that you want to take a lovely early retirement and pursue further ventures. You don't really want to be involved in this business anymore. So that's really one of the big benefits. Oh, there's a pointer on this that would actually accrue to you. What are some concerns that you should have? We'll just advise you briefly on these. The buyers may not want to buy the shares because there's possible hidden liabilities. However, you can probably even leverage this as a negotiation tactic for you, as our advisors will go into shortly. Now, we just wanted to give you a sense of what the valuation of your company was. We did not have the fair market value of the shares. So we used the total assets and total liabilities as well as the fair market values of these bad boys here, Class A and Class B. And what we did, so as you know, we presented the total assets on a previous slide, and we got to a total value of $1.393 million. I will now pass it to Florence, who's going to be talking about the methods of the selling shares.
So there's two methods to dispose of those shares. So I'm going to first of all talk about the redemption and then about the selling of the shares. So this will, by getting rid of the shares, you will get rid of the total ownership of the corporation, and Fishnet will have the total ownership of that corporation. So I'll start off with the Class A shares. So for Class A, if you wish to redeem the shares, the proceeds of disposition will be $10, with a puck of $10 resulting in no deemed dividend and no capital gain. If you would like to sell those shares, so that would be a proceed of disposition of $10 with an ACB of $10, resulting also in a capital gain of 0. So for the Class B shares, the redemption would have a proceed of redemption of $2.4 million, a puck of $10, so resulting in a big deemed dividend, and with an ACB of $10 and no capital gain here. For the sale, it's also proceeds of disposition of $2.4 million, and since the ACB is only $10, you also have a huge capital gain of roughly $2.4 million. For the common shares that are owned by the trust, so you can sell those shares for proceeds of disposition of the fair market value of those shares that we calculated earlier of $1.39 million, with an ACB of $10, resulting also in a big capital gain of $1.4 million. So in our case, it's preferential to sell the preferred shares because they most likely don't have the liquidity to redeem those shares. And by selling the shares, you will have a big taxable capital gain. But since we are a QSBC, you're able to distribute that capital gain to the beneficiaries of the trust, and they can use their lifetime capital gain deduction of $824,176 on that gain to offset it completely. Since Aqua doesn't have the current liquidity to redeem the shares, they could perhaps get a loan, get some debt, but that's not necessarily a good option because Fishnet already doesn't want to acquire the PPME and most likely doesn't want to acquire a company that has more debt. So this could also be a good negotiation tactic because once Fishnet acquires the shares, they can sell the PP&E that they don't need, and they're going to trigger some recapture and some terminal losses on these. So the equipment can be disposed of and trigger a terminal loss of $116, and the vehicle can trigger a terminal loss of $140,000. So that can be used against the recapture on the building of $100,000 and can be useful. Okay, so second of all, for the sale of the assets. So if Aqua disposes of all the assets except the one that Fishnet doesn't want, so they explicitly said that they didn't want the property, plant, the equipment, and the vehicle. So that comes up to a total fair market value of the assets. And they're also going to dispose of the goodwill. So the goodwill is for a total of $1 million. So there are going to be tax consequences on the sale of those assets only on that $1 million because the cash, account receivable, inventory, and prepaid expenses are disposed at fair market value, and the book value is equal to the fair market value, so there's no tax consequences. For the goodwill, it's disposed at $1 million, and since the cost base will be zero, they will have a taxable capital gain of $500,000. The other half is included in the CDA account, and it's added to the $10,000 balance that was already there. So that CDA account can be used afterwards to pay off tax-free dividends to the shareholders. So the total tax consequences of that transaction will be only the tax on the $500,000 taxable capital gain of the goodwill. So that is going to be included in active business income, as taxable capital gain on goodwill is considered active, and it will be taxed at a rate of 10.5%. As we said, this corporation qualifies for the small business deduction. So here are the criteria. So it needs to be a CCPC. It needs to have capital employed in Canada of less than $10 million, and the amount will be the lesser of the limit of $500,000, the active business income, or the taxable income. In our case, it's limited to $500,000, so the tax consequences will be $52,500. So by selling the assets, Paula will still have an implication in the company because she did not get rid of the shares. So we will recommend to more, And after the corporation is, after the assets are sold, she can sell the assets that are not taken by the company and resulting in those following terminal losses and recaptures. An option is to use ITA 88.2, but we can come back to this later in the Q&A. Okay, so I'll pass it off to Naresh for alternatives.
So now that you want to remove yourself from the management of the corporation since you want to retire early, what are your alternatives? So if you were to wind up the corporation, you'll have to pay tax of roughly $79,000 based on the disposition of all the assets you currently own. But what you can do is, you do not need to wind up the corporation right now. What you can decide to do is keep the corporation, make it into a specified investment business, and invest the amount, the cash you'll have in the corporation into property income and earn interest and or dividends from it. Now, what will this imply? This will imply that now that you own investments, you'll have to pay additional refundable tax of 10 2/3% on your aggregate investment income, along with any Part 4 taxes, which is of 38 1/3% on any Canadian portfolio dividends. Now, you will likely not be able to deduct small business deduction because you are SIB and you do not have more than 5 full-time employees. And you can have tax deferral on this because you do not need the income right away, so you can slowly take out income in forms of dividends from your company, Aqua Inc., which will be now a specified investment business. So if later on in the future you wish to simplify the corporation because you currently own Tools Plus, which is a holdco, and you will now own Aqua Inc., which will be another specified investment business. Instead of holding two corporations, what you can do is try to simplify the corporate structure of it. So what you can do is you can do a Section 85(1) rollover to transfer the preferred shares you own of Aqua Inc. to the Tools Plus corporation you have in exchange for shares in Tools Plus. And since you are related to Tools Plus and you deal at non-arm's length, there's a possibility of triggering 84.1 dividend stripping, so we must ensure that the boot you receive has to be less than the puck, which is of $10. And then the trust can later distribute its common shares of Aqua Inc. to Tools Plus. Since Tools Plus is a beneficiary, the transfer can be done on a cost basis to Tools Plus, and it will trigger no tax consequences to either you, Paula, your family trust, and Tools Plus. So, as we've mentioned, you are here right now, you have preferred shares in Aqua Inc. and the family trust has common shares. Where we'll be in the future is you, Paula, will own 100% of Tools Plus, and Tools Plus will now own 100% of Aqua Inc. because of the Section 85(1) rollover. Now, there's a possibility later on that you can completely wind up Aqua Inc. So this is a parent-sub relationship between Tools Plus and Aqua. You can do a Section 88(1) wind up, which will result in no immediate tax consequences because everything will be rolled over to the corporation on a tax-free basis. Now, you've also came up to us for some estate planning and family planning. You currently have an intervival family trust, which is taxed at the highest rate, which is currently 33%. Along with it's a discretionary trust, so everything that's transferred into the trust is disposed into at fair market value, and everything that goes out to the beneficiaries are at tax values. So the trust, the main purpose of the trust here is to keep the control of the assets and to ensure privacy and avoid probate fees if you were to pass away. And since this is a family trust, we must ensure that we stay out of the 21-year deemed disposition rules, because after 21 years, all the properties in the trust is deemed to be disposed at fair market value and reacquired simultaneously at fair market value. Corporate tax planning, we'll get into the question period. And family tax planning, you have an imputed interest benefit of $200 due to the shareholder loan, along with you can contribute to RESPs and TFSAs, which we will get on into the question period shortly. In conclusion, we came today to talk about the federal tax payable of your corporation and the offer. Thank you for listening. Happy New Year. We open the floor to questions.
So one of my first questions is, in your, what would be the best or more tax-effective way of selling this, disposing of the assets? You've dealt with both situations, but what would be the most tax effective way of doing it, I guess? And, okay, I'll start with that question.
Yeah, sure. So we came to the conclusion that it's better to sell the assets, simply sell the assets without a wind-up, because that results in only $52,500 of taxes payable to pay, and all the other options were obviously resulting in more taxes and more tax consequences.
Okay, so I wouldn't have any other additional taxes when I take out the money from the corporation?
Well, you could keep the money in the corporation. You don't need to take it out, but if you were to take it out, you could take it out as a form of a dividend, and that will have to be grossed up and added into your income. But if you were to keep it in your corporation and invest that portion, it could now be a specified investment business, and that the portion will be property income to the corporation.
So I guess I would be deferring my tax obligation. And have you taken that into consideration into your plan of how I should be, what would be the most tax effective way of doing things?
So the most tax effective way would be to sell the assets that Fishnet wants to acquire, and keep the money inside the corporation, and don't wind up Aqua Inc.
Okay.
And yeah, please.
I'll ask a question also, if you don't mind, if we still have time. So basically my understanding of your planning was I'm transferring all their shares to the holdco, and we're doing a wind up, and that's for the disposition of assets. What if I decide to simply sell my shares to a third party? I'm wondering what would be the tax effect on selling my shares to someone I'm not dependent to.
So if you sell your shares to a third party, you're going to have an immediate capital gain upon that.
Okay.
However, because it's a QSBC, you would be able to claim the lifetime capital gains deduction. The reason we're saying to you to sell the assets directly is because our incremental analysis showed that actually selling the assets is more has greater tax advantages. The lifetime capital gains deduction doesn't necessarily consume the entire large capital gain as a result of the disposition of the shares.
Okay, and I was told from a friend of mine that because when they first approached me with the idea of reorganizing my structure and implementing a trust, that I would be able to beneficiate from additional lifetime capital gain, but I'm not sure if it's just a rumor or if that's actually something I could do, because that's the purpose of why I've done my planning. So I'm just wondering if you could fill me in a bit of on that tax effect.
Well, the trust, because if it's a QSBC, you can use a lifetime capital gains deduction because the beneficiaries, the amount will be allocated to the beneficiaries. So you and your husband, they're both beneficiaries of the trust, sorry. So if the trust were to sell and if the company qualifies as a QSBC, the portion will be allocated to the beneficiaries.
Oh, is that right? Okay. Okay, now I get it. So then I would have additional capital gain exemption, okay.
Right, exactly.
No, you asked the question I wanted to ask.
Okay. So, if we still have time, then I'll fill you in. Did you consider because you're suggesting that I sell my assets, which would be a minimal tax impact for me?
Mm-hmm.
Did you consider if I go on and multiply my capital gain exemption, what would be the tax, I guess the tax savings, if there are any? I'm assuming there would be some tax savings if I go on and sell my shares.
And take the capital gain. I guess the total tax between personal tax and corporate tax, what would be the least amount of tax I would have to pay with the sale of assets?
Period of question is over.
Sorry.
Okay.
It's okay.
Yeah.
Thank you.
Thanks.
Love me, guess you don't remember.